Hi, everybody. It's really good to see you all here. Thank you so much for joining us for this wonderful event where we're going to talk about how to close a fund. My name is Mike Supervici. I'm the head of acceleration here at Desal Group. If this is your first time joining us here on an event like this, these events are designed to be highly interactive. You can say hello into the chat. There's a Q&A button where you can ask me all sorts of questions. And just a little bit of brief background on us and what we do. Desal Group's an organization whose entire purpose of existence is to help new and emerging managers thrive. We do that through training. We have what has become the leading accelerator for venture capitalists. It's called VC Lab. We also train limited partners on how to invest in venture capital funds. We also train associates on how to work in venture capital funds. So we have an entire training component that's built to help folks in the ecosystem just do really, really well, okay? We also have a product called Desal Hub. It's become more or less the operating system for venture capital. It handles everything, end-to-end operations for your VC firm. We have Desal Partners, which is a back office, tech-enabled back office platform specifically built for emerging managers. And finally, we have Desal Capital, which is a fund of funds that's investing in the top performing venture capital firms that come out of the network. So systematically, if you sort of look at the way we work and the way we do things, we're trying to sort of reduce the barriers to entry for new and emerging managers to go and launch the next generation of enduring venture capital firms. But one of the primary ways we do that to help folks is that we host events like this on a regular basis. Every single week, we host an event like this where we just try to share all the stuff that we know and learn, just to kind of give you a sense of scale. And what we do work right now in VC Lab Cohort 16, okay? So we've already trained thousands of venture capitalists. We've launched over 400 venture capital firms worldwide, okay? So we've seen a lot of things that work, a lot of things that don't work. And we use events like this to try to share these lessons to help you hopefully avoid some of the pitfalls, some of the mistakes that other folks before you may have made. And hopefully you have a little bit of an easier time sort of getting out and launching a new venture capital firm and funding a lot of cool things that matter to improve the world, okay? So let me just do this. Let me give you a little bit of background on what's going to happen today. Then I want to sort of, for all the folks that are new, I want to give you a little bit of kind of advice on how to, get the most out of the session, and then we'll go ahead and get started. So I'm going to spend the next 20 minutes or so going over some of the principles and best practices of launching a fund, okay? I'm going to share a presentation, give you some thoughts and all that. Then I want to go out and answer your questions. So at the bottom of your screen, you will see a Q&A button, right? It's got like a little question. You might have to like open up the window a little bit more. And there you're going to be able to sort of add your questions. You're going to be able to upload them, and I'm going to go ahead and prioritize those, okay? On the right-hand side, there's a chat. I'm not following the chat for questions. There's just going to be a lot of people on this call. So it's going to be really hard for me to follow that. So if you put questions in there, I'm just not going to look for questions. This is a public webinar, okay? And because it's public, avoid sharing anything related to your thesis, your fund, or whatever you're working on, because that's considered general solicitation. And general solicitation is a pretty serious legal issue for many, many folks. In many countries in the world, you can literally go to jail for marketing a private fund, okay? So do not talk about what you're actually building, okay? You can say, my name is Josh, I'm from this, and you can put your LinkedIn in there, and that's cool. No problem. You can have a conversation, but don't go out be like, hey, I'm investing in these kinds of companies. That's potentially general solicitation, so avoid that. All right, so let's go get this show on the road, okay? Let's do it. All right, so today we're going to talk about how to launch a fund, okay? So let's go ahead and get going with all this. So look, a lot of people make the mistake of kind of like thinking about how to engineer their fund And many people that start funds come from like a very entrepreneurial background, like you probably have started a business before or something like this. And so one of the first things that a lot of people do, which is a huge, huge mistake, is that they try to launch these funds kind of in a similar way. So one of the first things you do as a entrepreneur is you like incorporate a company, you like start working on a deck, you start building a product and all this other stuff like that. All that stuff is not applicable to launching a fund or in a VC firm in general. Okay. When you start a VC firm, the last thing that you do is talking to lawyers and service providers and figuring out what all the costs are and all this other stuff. Okay. So if you're right now on this call and you don't have at least $1 million to $2 million in signed letters of intent from limited partners that they're going to actually invest in your fund, not verbal, okay, not like, hey, I'm going to invest in your fund, but like signed letters of intent, you should not be talking to lawyers. You should not be talking to service providers, and you should not be wasting any time on that. Okay, that's the last thing that you do. Okay, and I'll cover that in a little bit as to why, but just want to kind of give everybody a little bit of a warning because we see a lot of issues with this and we see a lot of people end up in a lot of trouble doing this. Instead, what you should be doing is working on your thesis. If you do not have a strong thesis, you're going to struggle to get commitments from limited partners. And everything you build moving forward from there, like your materials and all this other stuff, are just not going to work. And so you're going to have to redo them. So first, build a thesis. And a thesis is not what you say to the world to attract founders. This is another huge mistake we see people make. A thesis is what you tell limited partners, okay, to get them to invest in your fund. All right. We have a pre-curriculum that helps you walk through how to think about this thesis. And it's super hard, everyone. I know it's like a sentence, but it's actually really, really hard to get this right and do it well. But when you get it right, okay, 1 in 5 limited partners are going to say, yes, I'm in, and they're going to sign a letter of intent without any materials. This happens in every cohort that we run. We've run, like I said, 400 venture capital firms we've launched, right? So we've know this is coming from experience, not sort of like kind of random, like, we just voodoo magic, okay? So go to this curriculum, work on your thesis, get that really good. And the way you know it's good is you're going to talk to your peers and your friends and people in your network, and they're going to like sign a letter of intent to come in. I think this is a really good fund, okay? Now that you have a thesis, right? Now you can actually target the right limited partners to go after in order to raise this fund, right? Because let's say you're doing like a space fund, okay? You're going to invest in space tech. And you talk to a limited partner and you say, hey, do you believe that, space is the next frontier? It's like, I don't care about space, man, right? Like, that's bad. Like, you wasted a whole bunch of time talking to the LP that would never care about what you're actually working on. This is why it's super important, right, for you to make sure that you find LP, GP, thesis, fit. It's kind of like, like product market fit is the same concept, LP, GP, thesis, fit, okay? And so you want to start creating LP archetypes, okay, that make sense for you to go out and target so that you can go speak with the right people at the right time that can actually fund your fund. And we've actually built out a GPT for you, you are going to need the latest version of ChatGPT for this to work. But if you want to sort of take a look at that, this actually helps you do it. So once you have a really good thesis, you can literally put in your archetype in there, and you can go out and it'll actually spit out a few types of people that you should be thinking about going after to go out and discuss your thesis with. And that will increase the probability that you're going to convert them to a signed letter of intent very, very quickly. Okay. Then what you want to start thinking about is, okay, cool. So like this is starting to work. I've got a good thesis. I think this is working. I think that I'm going to be able to pull this off. Okay. And I think I'm going to be able to make this, an enduring venture capital fund. Okay. Now let's go ahead and start thinking about like the LP construction for this fund so that I can go ahead and target the right people at the right time. So what does this maybe look like? You may have, a couple like family offices in there. You might have some exited founders, right? You might have some, personal alumni network kind of folks, right? Why is this important? Because you want to go after these folks at the right time. For example, if you don't have a whole bunch of your personal friends and network committed to your fund, you're going to really struggle with the high net worth individuals. You're going to really struggle with the family offices, right? Like if like the people closest to you that you've worked with, that you've had relationships with, that are not buying into this, it's going to be hard. It's going to be harder for you to get the other folks, right? And so you want to sort of kind of ratchet up the ladder, sort of what we call it, right? So basically, most people, when they fundraise, they start at the bottom here, right? They get like alumni network, angels that they've maybe co-invested with, that kind of folks to commit for smaller tickets. Then they go ratchet up to bigger tickets, and eventually they'll end up with like family offices, that kind of folks, those kinds of folks. The folks up here, family offices, fund of funds, corporates, first, they rarely do fund ones. Okay, so there's a small subset of them that maybe will do it. So if you're on fund one, this is just generally not a good prospect for a lot of folks. And two, they rarely come into first or second closes in the fund. Okay, and so like you spending time here in this like top row is just not the best return on investment per unit of time, right? It's just not. So you want to sort of kind of focus more on like high net worth individuals that can sort of make a decision on the spot and make this work, just to kind of get enough of a base to get out and get operational, maybe even make some investments and that kind of thing. So this is an example. Some of you on this call might already be sort of on fund 2, fund 3, fund 4. Maybe you're like kind of later in the emerging manager kind of, as an emerging manager, your LP construction might be different just because you yourself happen to be an emerging manager. So in other words, you're now on fund 3 in a series of funds. You've already kind of raised your fund 1 with kind of high net worth. You proved yourself. Then you kind of went to fund 2. Maybe you got a couple family offices. Now you're like really ready to get institutional grade into like fund 3, right? So your LP construction is going to be different. This is important though, because that's how you're going to know where to spend your time. Okay. Then you want to sort of now you got to like research. All right. The cool thing about like the GPT that I've given you is that it kind of gives you some thoughts, gives you some keywords and things like that to sort of work with, but you're gonna have to go and find these people and activate your network to get them. A lot of times people tell me stuff like, well, can you just give me a list, man? Like, I just want to have the list. Like, no, lists don't work. They're a waste of time. You see a lot of people on Twitter and all stuff like sharing lists. These lists are not useful, okay? The reason that they're not useful is because remember what I said at the beginning, when LP, GP, and thesis like kind of are aligned, like magic happens, right? And it's really hard to sort of kind of triangulate from some random list. It's all, all of the access you're going to get to limited partners is primarily going to be from your network and your network of networks, right? So your network is going to create network effects, create more introductions, and that's how you're going to get to, everything you need to sort of kind of make this happen, okay? So hopefully that gives you a sense here, and this is why it's so important. And so you're going to take these sort of like keywords, go into LinkedIn, find the right person, find the second degree connector, you're going to shoot them off an email, and you say, hey, can you introduce me to so-and-so, okay? So that's step number 4. Okay. Then what you want to do is you want to sort of like, people are not going to just randomly connect you to limited partners, everyone, right? Like, just think about it. Put yourself in your shoes. Put yourself in your shoes, right? Like, if I came in, you don't know me, it's the first time you've ever seen me on a Zoom or something. I'm like, hey, can you introduce me to this limited partner? You're not going to do it, right? And so you really need to make a compelling case to connectors, especially connectors that like care about you, that are like, like close to you, as to why they should expand their social capital to make this introduction to this person, right? So either way, to help you, we've created another GPT. It's called the connector GPT, and you can use this GPT to sort of find the right connectors to the right people that you need. So hopefully this will be a little bit helpful for you as well. All right. Now you want to start kind of setting up meetings, but in these meetings, you don't just like open up the meeting like this and you drop a deck or something on this LP and it's like, let me pitch you your fund. Like, no. Like in many places, like I said, like in Europe, for example, it's you can't even do that. You actually need to like do what's called pre-marketing, right? So you actually have to introduce yourself, spend a little bit of time discussing and if the LP asks you about what you're up to, you can tell them about the fund, right? So it's really important to sort of think about this. And it sort of makes sense. Like if you don't know the LP very well, right? Like you want to build a relationship first before you go out and actually ask them for money, right? It's just kind of the normal way to do it anyway. So it's not like it's so restricting or anything. Like these general solicitation laws are so restricting. They're not that restricting. They're actually helping you do something really well. And by the way, you don't want to be out generally soliciting, even if it was legal, because that looks super bad and super cheesy, right? You're like, like a professional money manager, and you're like out there on LinkedIn, hey man, can you invest in my fund? Like that looks bad, right? It's just that there's no exclusivity to it. It's not good. It's not a good look for you. It's not that helpful, right? So it's not, it's okay. Just work within these boundaries and you're going to be just fine. Okay. And then, once you meet some of these folks, and you ask the LP as well, like, ask the LP for money. Is this something you'd be interested in participating in? A lot of people have these calls with some LPs and stuff like that, and they never ask, they never make an ask, right? So we see the other side of this as well. So just make sure you make the ask. Super critical. And a lot of people that are outside of the VC Lab network really struggle to close. Use pacts, everyone. Pacts are letters of intent, right? Letters of intent for people to sort of commit to a fund. We have built these templates for you. You can take a look at them on our website. This helps you figure out who's real and who's not. Because look, there's like no upside in someone telling you no, and there's no upside for them and then telling you why they said no. Okay. Right. It's all downside, right? Because you might get upset, you might not feel very good about it. There's just no upside at all. So a lot of people, what do? They say, oh, this is super interesting. I think this is cool. I really like it. Let me think about this, that kind of stuff, and you kind of live in this world of basically BS, right? And so what the pact allows you to do is figure out who's real and who's not, right? It's like, great, here's a sign. Great. I'm glad you like the vision here. As a next step in the process, we're going to send you a letter of intent. It's non-binding, but it does have some light confidentiality in language, which allows us to share more information and draft the definitive docs when we're ready. So I'm going to send that to you after this call. Does that sound okay? Great, send it to me, right? And you send it to them, and if they don't sign it, they're not real. If they sign it, then they're like, yeah, they have a 75% chance of closing them, right? And it also makes it a lot easier for you to send them legal docs later, right? Imagine like someone talking to you, right? And they're like, I'm in, and then you slam them with like 80-page legal doc. Like, my God, right? Think about how hard that is, right? But if someone's already made the commitment basically in their mind to invest by signing a pact, then you following up with legal docs after that is just another step in the process. And it's a lot easier for you to get those done, right? And so there's lots of like reasons for this. There's why this makes sense. So just something to kind of think about. But use a pact. The pact is like your best friend. And that way you don't live in sort of like this world filled of like BS, basically. Okay. All right. Now that you have enough pacts, and you need $1 million minimum, okay? Minimum before you hire a law firm, before you talk to some fund admin providers about the stuff, like, at least $1 million signed letters of intent. And possibly even more, because again, a signed letter of intent converting to an actual signed document and into an actual wire is typically 75% in, what I would say developed ecosystems, and it's lower in developing ecosystems, right? So you need that because you're going to do what's called a capital call, and I'll talk about that if you have questions about it. And that's going to be 25%. So if you have $1 million circled, right, you're going to call 25%, that's 250K. You have to pay legal fees out of that. You have to, get some management fees out of that. And, there's just not a whole lot to go around. You maybe make one investment with that. Okay. And so, just make sure you do get at least $1 million. And for those of you that have fund sizes that are greater than 10 million, then you need a minimum of 10%. And LPs are going to hold you to that too. They're like, well, you got to get 10%. Okay. Otherwise, you're never going to get to the target. Okay. Now you start a formation. Now that all the people that have signed, now you notify them, right? It's like, hey, things are going great. We're starting a closing. We're drafting the definitive docs. Just wanted to let you know that this is happening, and we're gonna send out a capital call in about 3 to 4 weeks from today. Does that timeline still work for you? Right now, right, like where everybody's at. Yeah, I'm in. That's great. That works. Oh, I need a little bit more time. Oh, okay. Now right, like that person maybe is not as hard as you thought, right? So this is the next thing you sort of want to do. Then you send out the docs that your law firm created for you. They're called LPAs. LPA stands for Limited Partner Agreement. You send it to them for them to do that. At the same time, if you're working with a reputable kind of or operations kind of service provider, they're going to set up everything else, bank accounts, that kind of stuff, or help you with that. You're going to probably nag because no one's going to just like sign. I mean, some people are going to sign because they're like your friends or whatever, but like, you're going to have to like nag them a little bit. And you don't just want to be like, hey, just bringing this up to the top of your inbox, like that's not going to work. Okay. You got to send some news. Hey, by the way, good news that XYZ happened. Have you had a chance to take a look at the docs, right? You kind of want to show momentum when you're trying to do a closing, because that's going to help you get this done in a very, very effective way. Now, a lot of people mess this up. So everybody, like, if you've been like sort of kind of checked out and like are like, like doing something else, like at work right now or whatever. Okay. You never, ever, ever want to countersign a document before KYC and AML is done on that limited partner. Okay. Compliance is becoming a huge issue right now because of sanctions. There's lots of other reasons for it. There's new regulations. There's new SEC regulations. There's new regulations in other places in the world as well. And so, a lot of people make this mistakes. They countersign docs. When docs are countersigned, they're final, right? And so you can't countersign a doc. Everyone just keep that in mind until AML is complete, and you make sure that that person is actually, a good individual that's good standing. Okay. Now you do that. You admit LPs into the fund, and you send them what's called a capital call. This is say, okay, great, you're in. Wire 25% of the commitment up front, and that's when you do that. And then, of course, nag until the money's in the bank. All right. So, that's the process. Now, once you do a closing, if you work with like an operations provider like our Decile Partners offering, you're going to be able to do what are called rolling closes. So you can take down, whatever LP wants to come in after that for 250, 500, whatever, you can just do it. Most traditional back office providers and law firms, they're just too expensive. So what you're going to have to do is bunch everybody up and kind of go through the same process we just went through to make sure that you kind of get a few closes in kind of at the same time. Okay. Obviously this looked sort of relatively like kind of straightforward or whatever, but it's not, as you could probably imagine. This does take a while, and you're going to have to pitch a lot of LPs. There's just no way around this. So, if you're not ready to go out and pitch hundreds of LPs, I mean, you're going to really struggle here, so just want to make sure you're aware of that. Really quickly, I want to talk about this before I wrap, and I want to start getting to your questions. I see there's only one question into the Q&A. So if you have questions for me, put them into the Q&A, and I'm more than happy to sort of answer it about anything. There's this phenomenon. There's actually a term for it. It's called LP love. And like I said, there's no upside in people giving you direct feedback. So a lot of people tell you, I love this. I love what you're working on. I love it. And they will never give you like a no. And there's so many reasons for this. A lot of it is some people just want to keep maximum optionality, that kind of stuff. They don't want to take the deal off the table, that kind of thing. But you live sort of in this world of like kind of like BS. So you got to sort of, you got to counter this, right? So, I'll give you a few sets of objections that many of you have gotten. Okay. Probably your fund is too small. And that's totally always pretty much always bullshit. Come back next year, we're maybe looking at this. And basically, the way you want to sort of think about this is that every like non-yes is kind of a no. Okay. Versus like, oh, I can just fix it and make this a little bit better. And no, right. So it's basically a no, and you got to sort of move on versus trying to sort of fix that situation. Okay. And a lot of times we see this in our cohorts too, is like, wow, a lot of people like, just change their strategy. Oh, LP told me my fund is too small. So then they come back and like, I'm on $25 million fund versus like a 5. It's like, that is a really, really bad thing to do. Okay. And it actually makes you look weak. That makes you look like you don't understand what you're doing. Don't change your strategy because LPs are telling you no. Okay. You can, it's just like you're pivoting on like your life's mission, right? You've committed to doing this for 10 to 15 years. It just doesn't make any sense for you to sort of change it like this because LPs are telling you no. So anything that's not a yes is a no. Think of it like this. I know it's not easy. Obviously, this comes from a place of empathy. I want to be clear about that. But if you sort of think about this like this, it'll at least make your return on investment per unit of time a little bit better. All right. If you want help with this in the VC Lab Accelerator, we literally hold your hand through this entire process that I've just outlined here with lots of help, advice, and all that other stuff. Cohort 17 has opened up admissions. So if you want to go ahead and apply for that, just go ahead and go to govclab.com. So I'll stop sharing right now. Let's go ahead and get into the kind of AMA portion of this and go from here. I see that there's several questions. There's six questions in here. Please upvote them, and then I'll go ahead and prioritize them. In the pre-curriculum, I saw that the bank account setup usually comes last. You mentioned you have at least $1 million to start the fund. Where should the money be kept? Yeah, you're not going to close on money. Money's not going to be wired into your account, okay, until you follow the process that I outlined in the deck, Jennifer, right? So there was no, like, do you see how like I think it was like step 14 was the capital call? That's when you ask people for money. That was like step 14, right? So it's like the last thing you do. So what's happening is that LPs are signing letters of intent telling you that they're in, and only then do you want to start formation, right? It's like formation for funds. It's complicated. You're forming 3 different entities. It's really expensive, costs like $50,000 to $100,000 to do this correctly. The good thing is that the fund usually pays for it. So it's not money that's coming out of your bank account. It's coming from the fund's bank account, which is why you have to have enough commitments to be able to get operational to get this done right. And then the bank accounts are set up. They're not your personal bank accounts. They're not Jennifer. No one's going to wire money into your personal account. It's like the bank account of the fund, the bank account of the GP entity, and the bank account of the Manco. And so that is one of the last steps that sort of gets done right before you go out and send out a capital call notice. So capital call notice is one of the last things you sort of do. How do you accomplish AML checks? You work with a reputable back office provider. This is the other thing where we see a lot of people make mistakes. They're like, oh, this is a fund 1, fund 2. I'm going to work with my cousin that's like an accountant, my cousin that's a lawyer. No, like you have to work with specialized providers that know what they're doing. So for example, if you're working with a law firm and you're interviewing a law firm and that law firm doesn't basically specialize and do nothing but VC formations, like you're kind of like not working with the right law firm. The accounting for back office and venture capital firms is very, 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 very specialized. It's not the kind of accounting that you sort of hire an accountant for. You need compliance folks, right? These are so a good back office organization provider is going to do all this stuff for you, so you don't have to worry about it. But that's why it's critical you work with the right people to make this done. So your vendors are going to help you with this. Advice about finding and negotiating with potential anchors. Anchors are dead. There's no such thing as anchors, Chris, anymore. Like that's kind of a thing in the past. People used to do anchors way back in the day, and they used to kind of like get crazy economics and stuff, but that's not really a thing anymore. So the way you actually do it is the way I've kind of told you to do it, which is basically you start actually at the bottom with high net worth individuals. You get a whole bunch of them to commit. You do a first or second close even on the fund. You make some investments, do some deal memos that allows you to get a little bit bigger tickets because the fund is being de-risked, and you're now kind of in a what I would say, the fund's been marked up and things like this, and this is how you ratchet up to like the kind of $1 million things. But like the idea of anchors, that's kind of a thing for the past. That's what used to happen back in the day, like in Silicon Valley when people would spin out of VC firms and things like this. But I mean, look, we've launched 400 venture capital firms. I think out of those, maybe 2 have anchors. Just kind of give you a sense, right? So yeah, you don't need an anchor. What's your thought process of finding your jurisdiction? Really good question. Again, another reason why incorporation is the absolute last thing you do. Okay, so you go out, you get these $1 to $2 million, and maybe you have a couple big LPs in there, 250K or 500, maybe even one for $1 million, whatever, right? And they're like, I don't want to invest in a fund that's headquartered in Mauritius. Okay, I want you to be in Delaware, so you're going to put the fund in Delaware, right? So LPs are going to help you decide this. Is sort of how you want to think about this, Artem. The majority of VC funds right now are being incorporated in Delaware, and the reason for that is because it's the least expensive jurisdiction by far, and most of the people on this call are going to have very, very small fund sizes. The second reason for that is that you just have a really good like market of providers that can compete with each other. The third is there's not as big of a regulatory burden. For example, like any domicile, whether it's Estonia or Luxembourg in Europe, is you're just in fees alone, you're like, it's like 30,000-40,000 euro a year in just fees, right? A formation in Luxembourg starts at 100,000 euros, right? And so it just becomes incredibly expensive. And you can't make that work with like a $5 million or 5 million euro fund or 10 million euro fund. So most new managers that have tiny funds are putting their funds in Delaware. Another really good and attractive one, domicile for LPs that for whatever reason don't want to touch the US nexus, is Ontario. Ontario is pretty good. And then if you're able to sort of go out and raise a little bit more capital and have the means to go out and raise like $20 million, that level, BVI is pretty good. We support all 3 of those, and as well as Estonia as well with what we do. But as a general rule, for most people, it's going to end up being Delaware. And guess what? Most of your best companies are going to be in Delaware anyway, right? Because a lot of companies that are international are going to make the Delaware flip, because a lot of the VCs are in Delaware as well. I'm going to go ahead and refresh this list. It would really help me if you all just go ahead and start upvoting some of these questions. Is it good practice to do cold outreach to LPs? No, it's a terrible practice, and it's going to get you in trouble with the law because that's considered general solicitation. Never ever cold email LPs. It's not effective either. Like think about it. Like think about what it takes. Like this is not like investing in a startup. It's investing in a person. So when you're starting out a VC firm, you're professional money managers. The people that are investing in your fund, they're not like investing in a product like they want it, or a company that's going to make a product like people do when they angel invest in startups. They're hiring, in this case, Andre, to go out and manage their money for 15 years. So it's the idea that you can sort of cold outreach to some high net worth individual and say, hey, high net worth individual, let me go ahead and manage your money for the next 15 years by funding these super risky companies that are called startups, even though I don't have a lot of experience or haven't done this before, is a pretty big ask, right? It's like it's virtually impossible to make that work. So the cold outreach doesn't work. You have to go through connectors and through your network to get to where you to the people that you need. And there's unfortunately there's no shortcuts to this. Is it feasible to establish a fund without prior experience in startup investments? Yeah, we've actually had several do some really interesting funds. So as long as you have the thesis and as long as you have the deal flow, and then you're gonna be able to pull this off. But again, you need to have an edge, right? There needs to be a reason why you will win versus the other, versus the other 400 VC firms that we've launched, versus the other ones that we haven't launched. Or there's got to be a reason why you have a unique advantage. We call that the secret sauce, and you can see that in the thesis pre-curriculum. So you have to have a really strong thesis, secret sauce to make that work. What is the best way to include standalone deals previously done through SPVs with investor money to a new fund? And there's no way to do it. So if you've invested in SPVs, what you're talking about, by the way, just taking a step back, that's called warehousing, everyone. So warehousing means that you've made like an angel investment into a startup, you transfer that asset into the fund when you are ready to close at cost, right? So like, as a gift to the fund, basically, and that de-risks the whole value proposition. But you can't do that with SPVs. SPVs are funds themselves. And so the idea that you can transfer an asset from a fund to a fund, that's basically virtually impossible because there's so many other owners in the SPV that have ownership, and it's incredibly complicated and basically impossible. Okay, so you cannot transfer an SPV into a fund. You should not be investing in SPVs with your fund once you're actually out live. That's a huge problem for you. That creates lots of tax issues for you. That creates loss of control and lots of problems. So like basically, like you're gonna have to stop the SPV business and go all in on the fund. And you're not going to be able to warehouse the investments you've done to the SPVs. I wish I had better news for you. Okay. If LPs are giving love, but it means no, should we still be in touch with these people or move on? Yeah, really good question. So what you want to do is just put people on a newsletter. So everybody here eventually will have a newsletter. If you join the VC Lab program, we'll obviously systematically help you with this, and you're going to send out newsletters as part of the curriculum. But like, you should have a newsletter, Gurinder, and you should just put the LP love people on the newsletter. And that's how I would handle it. And then give them a little nag when you're doing a closing or something. Hey, we're doing a closing. This is something you want to see the definitive docs. That's a good way to kind of see if they're actually serious. Is there an expectation from the GP to put their equity into the fund? So yes. So this is considered your GP commit, and it's again, I don't make the rules. These aren't even rules. These are just sort of expectations. Most LPs expect GPs to be able to put in 1% of the fund as a minimum. It's controversial for lots of reasons, right? But that's basically kind of like table stakes these days. Just wanted you to know what the conditions on the field are. Now you can do that with cash, or you can warehouse, like I was telling the previous person, where you can move an asset, like for example, if you've angel invested in the company, or and you can move that asset into the fund at cost, and that can be part of your GP contribution. Do I need to sign up to a financial regulatory to launch a fund? No, look, in general, no. It really depends on where. There's a lot of like caveats, like if you do this in some like random jurisdiction where they force you to do stuff like this, maybe, but in like Delaware or something like this, you don't. Okay, just FYI. Okay. Grace has a question: is once you have 10% or $1 million, can they sell a person with KYC and ML? Yeah, Grace. So we do all of that because one of the things we learned, Grace, was that so we're on cohort, we're launching cohort 17. When we got through the first 3 cohorts, we realized just how brutal it was for GPs to kind of build out like back office operations. So taking a quick tangent here, in general, outside of like the VC lab and the Decile group sort of experience, uh, GPs cobble together 5 or 6 different tools using like a Zapier integration. They'll have like a Notion with like a Airtable with like whatever, and they'll do the same thing with vendors, right? There's a term called fund administration. It's a term that's misused, and what fund administration actually means is like accounting and filings, right? That does not include compliance, Grace. Just very to put that out there. Pretty much, Carta's not going to do this. Like Aduro is not going to do this, right? That's a whole different thing. Then they would have to hire like a law firm, and they would have to make that work, and they would have to figure out how to deal with sort of compliance and risk and all this other stuff, right? And so what we did with Decile Partners, we basically built all of that under one roof, where every one of these specialties is kind of working together versus sort of pointing fingers at each other. That's the other thing that was happening, is like the fund admin would like blame the lawyer would blame the bank. That it's just like it was a mess, right? So we kind of brought it all under one roof, so you don't have to worry about it. So that includes compliance, that includes all of accounting, fund operations, and it has a 94 NPS. Okay, so there's a link in the chat about this if you want to learn more. Okay. Yeah, so could you talk more about what services back office provided? So you beat me to it. I think I kind of handled some of this, right? So, like most like AngelList, Carta, like those folks, they basically do fund administration, that's accounting and filings. And that's not enough, unfortunately, because there's a pretty big legal ops component to this. Because, like an LP might, have questions about the legal docs and that you sent and all that. And it's like, you really don't want to go to the lawyer with that, because it's like $1,000 an hour, right? So there's like an actual like legal ops component that's necessary there. There's also a compliance component now, and that's becoming super serious, to the point where some LPs are literally requiring compliance officers in these funds. Of course, that's not viable for pretty much most of you. And so that's an issue. There's a whole kind of like treasury component to this, like how to deal with banking, wires, distributions, that kind of stuff. And these wires have to match the legal agreements. So that's kind of treasury and compliance. So that's also part of the kind of back office operations. And I'm telling you this, Bailey, just so you know, like I don't want you to get overwhelmed by this. Like I said, we handle a lot of this stuff on our own, or you can sort of put this kind of stack together. The only downside, the big downside that we found was just that a lot of these vendors don't talk to each other, right? And so you have to kind of triangulate, and it's kind of a mess. Anyways, so those are the folks, and then you need a law firm, basically. Now other folks also have what I would say like deal review. That's something we also integrate, so they actually look at your deals and make sure that the safe is on market and that kind of stuff. So that's another component. Sometimes you hire an associate for it, but most like $5-10 million funds can't handle that. So we just offer that all inclusive into the Decile Partners thing. Will VC Lab provide instructions to investors or introductions to LPs? No. And Marie, this is the same concept I just talked about, right? Like it's incredibly difficult for some random individual to invest in a random fund, And if you see any organization going out and telling you that I'm going to be able to give you LP introductions, you should be very wary. It's most likely a scam. Okay. It's very difficult for anyone to give you random LP introductions. Let's start there. Second, you need what's called a broker-dealer license to actually do this right and make any sort of money on it, right? And so like that's another issue. So a lot of them are illegal. And third, it's almost always disappointing, right? Because look, let's say I was to send you 50 LP introductions, Marie. Like you would have those meetings and you feel really good about yourself. I've seen this happen with some of these other programs, but then you don't get any money, and then you wasted all that time. What's the point, right? You need LPs that are going to give you money. That's what you do. So if you want to think about what our KPI is in our business, is actually money in the bank, right? Like that's how we think about this. And no, none of these organizations really have that, right? And so that's why most of the time they're kind of scams. Same thing with events. Like if you're invited to go to like Monaco or whatever, those are always a waste of money. Okay, there's just no shortcuts to this, everyone. I just want to be clear about this. Like I'm not. I wish there was an easier way and better way, but you're risky, you know, and a lot of people don't want to back risky funds that have never got started before. So hopefully that at least makes the point clear. Should I consider making an advisory board for my first fund and invite LPs? Or who should invite it to such boards? No, Artem. Like less is more. Okay. Like now, look, everybody here is going to have what's called an LPAC. Once you close, this is a limited partner advisory committee, and their entire job is to clear conflicts of interest. This isn't like advisory to help you with the fund. They're like, oh, you're about to go invest in this deal that you angel invested in. That's a serious conflict of interest. I don't know if we should do it or not. It's not a great place. It's not a great, like, it's not like people are like, oh, I want to be on your advisory board to just deal with all your problems, right? But you're going to need that. It's going to be like an insurance policy. So you're going to have an LPAC. But as far as like actual advisors to the fund, there's going to be very little reasons for you to sort of have those folks, if that makes sense. Hopefully that's useful. Like less structure is better in many cases. All right. I see there's one more question. If there's no other questions, maybe we can even wrap early, but let's see here. My venture studio entity got a primary business certified North Dakota and is eligible for angel match program up to 250,000, but I'm not sure how to might not play a role in this eligibility. Yeah, these things are typically not great. So let's just take a step back. There's only like 4 or 5 places in the world, not the United States, right? But the world, where it makes sense to put any sort of fund or even a studio entity or incorporate a studio entity. In the United States, is clearly you're in the United States because you're mentioning North Dakota, it's Delaware. It's basically Delaware or bust. These other states and other kind of organizations just don't have the infrastructure to do this well. And they're extremely expensive, and you're going to deal with people that have never dealt with this kind of stuff before, which increases an enormous amount of your issues through this. Okay, so you're going to put everything in Delaware. It doesn't matter about like the angel match program. Now, the other thing that happens with these match programs, so we've had plenty of partner funds that we operate that have done matching programs, and they're really complicated. Okay, for a number of reasons. First of all, they force you to put the money, like you're already getting this, right? They're already forcing you to put the money into North Dakota, right? And there's probably not that much deal flow in North Dakota. And therefore, if they force you to put the money in North Dakota, and there's not that much deal flow in North Dakota, right? Then the fund by definition is going to underperform, right? And so it creates like these like really challenging things to sort of work through. So what you want is to have maximum flexibility there. Maybe you have a founder that has been started in North Dakota, but then they move to whatever other place, that's okay, right? Like you kind of want to make sure that that's sort of done that way. And so the devil's in the detail with all these grants. Like I don't want to like rant on this anymore, but they can be useful if they sort of are applied correctly, but there's a lot of infrastructure and issues with them. So you know, it's always going to be the devil's in the detail, okay? All right. Okay, let's see here. So which are the best EU locations? How do you best choose? Peter, I want to be blunt about this. There's no good EU location. It really sucks to put your fund in any place in Europe. And again, maximum respect. It's not like a disrespect to like the entire continent. It's just that you're dealing with like crazy general association laws. You need marketing passports and all this other stuff. And you really can't make the math work. Literally, you can't make the math work unless you raise like 15 million euro. And most new and emerging managers can't raise that much money because the majority of limited partners don't invest in new managers, right? Like, so then what has to happen is you have to go to the EIF and try to get money from them, which you probably know is kind of a pain in the butt, and it comes with really bad like conditions and makes it really complicated for you to do. So it's really hard to get to that target. Now, assuming that you actually have the ability to get to 15 to 20 million euro in with high net worth individuals with no government help, okay, no government help, because that's how you're going to perform really well. And then what I will tell you is Estonia has potential to be pretty decent for you, but I would first look at Delaware. Most new managers that are launching out of the VC Lab program right now that are in Europe, and certainly the ones that are performing the best, are all doing their fund one in Delaware. Just want to put that out there because it's a pass-through entity, right? And so for like limited partners, it doesn't matter, right? Because they're going to pay tax locally. They're not going to pay, they don't have to worry about the Delaware tax or anything like that. But, the reason why we went and started building out an offering in Estonia is because, look, I mean, I can sit here and like talk about why I think some of these government LPs make your life really hard, but some of you are not going to listen and you're going to do it anyway. So, okay, fine. I'll give you what you need, right, to kind of make it work. But it's just not, if you can avoid it, it would be much better for you. Okay. What does closing a fund as a result to completing a cohort stand if we're not going to pitch actual LPs? No. The VC Lab program is a closing program. It's not a learning program. So if you're going into VC Lab, you're expected to do a first closing on your fund. Period. I mean, you're not going to learn about how venture capital works, or I mean, you will by doing, but it's not. And there's like reviews, and we're going to be checking your hard circle commitments and verifying them. It's like, oh yeah, I have this much committed. Great, let me see your packs, that kind of thing. So, come in when you're ready, but you're going to have to complete a closing to finish the program. If not doing rolling close, is it worth setting a date for the first close and the final close? You should set a date for the first close yes, only when you have the commitments. So you don't set a date, hey, we're closing on December 15th, and you don't have 2 million in packs or 1.5 million in packs right now. Like, you should not be setting any closing date. On the final closing date, you don't set that either. You're gonna have a fundraising period listed in your LPA. And traditionally that's 18 months. So basically 18 months after you've completed the first closing, you have to close the rest of the fund. Some LPAs have 24 months, and that's how you can sort of drive it. But, yeah, I mean, look, if you can avoid having to do, if you really want to be able to do rolling closes, I'm telling you, otherwise it's just more expensive, right? Because it's costing you per close. Your lawyers are going to have to be, so you kind of want to try to do rolling closes if you can. So what usually happens in a kind of high resolution kind of financing situation is you do a big first close, lots of rolling closes, maybe 10, okay? And then you do 1 or 2 big closes and you wrap up the fund. That's pretty normal, and hopefully that makes sense. So if you're launching a VC with senior professionals with a fund in the hundreds of millions, would that mean you have less obstacles where the HQ is based? Not necessarily, I can't tell you how complicated it is to run a fund in like Singapore or Mauritius, you need infrastructure. So yeah, if you can pull down $100 million and you can hire staff internally to deal with the minutia of legal ops, compliance, banking, complexity, then yeah, you should, and all these fees that you're going to have, because a lot of these places like Cayman, like BVI, their entire country's economy is fund administration stuff, right? And so you get a lot of corruption out of that, right? Like, just because like you got to work with the vendors there and all that, you don't have this sort of market, so it makes it a little harder. So yeah, man, ultimately the LPs are going to decide it, is what I would say. So if you're going to raise $100 million and they don't want you to be in Delaware, you're going to put it where they want you to. But I'm telling you, it's just not going to make it that much. It's still going to be hard. So assuming that the thesis is done and ready, and this is the final question, we got to wrap. One should find the correct LPs based on references and start the pitching process, correct? Yeah, so the way it's going to work, or the way you should do it, Teddy, is that you should reach out to like first degree connectors in your network. We call them confidants in the VC lab program. So these are like people you might have worked with that could be an LP that you know that have been in your network, and you have a catch-up call with them and you talk to them about your thesis. And if you do that well, you're going to get packs out of that conversation, guaranteed, right? If you're not getting packs, then the thesis needs work. So there you go. That's how you sort of handle this. All right, everybody. Hope